And welcome back. The Consumer Price Index, or the CPI, actually came in lower yesterday for June than was expected. So for example, the Consumer Price Index, or the CPI, which of course is a measure of inflation, of course, increased by 3% from a year ago, but that's the lowest level since March of 2021. That is what's called headline inflation, which includes housing and energy costs. So on a monthly basis, the index, which measures a broad swath of prices for goods and services, that's headline inflation, that increased by 0.2% on a month-to-month basis. That's compared to the Dow Jones estimates for an increase of 3.1% on a year-over-year basis, and also an increase of 0.3% from the previous month. So the CPI report regarding headline came in less than or slightly less than expectations. And by the way, I'm sharing this because I'm going to share how this is impacting rates today, or average mortgage rates today. And also I'm going to share some more early signs of home buying activity so we can kind of gauge which direction our US housing market is headed. I should have mentioned that at the very beginning of this video here. Anyways, regarding core CPI, which excludes food and energy prices, that increased by 4.8% year over year, and also increased by 0.2% on a monthly basis. The estimate was a gain of 5% year over year, and a gain of 0.3% month to month. So both headline and core CPI came in slightly below forecasts. So to summarize here, the numbers give the Federal Reserve some breathing room regarding future rate hikes by the Fed, of course. This is because inflation has been winding down from the 9% annual rate we saw back in 2022, when at that time, that was the highest rates of inflation going back to November 1981. But inflation is still remaining sticky, and also it's well below their target range of inflation at 2% as well. So here is what the future expectations regarding the changes in rates for the year. And this is what's called the CME Fed Watch tool. If you Google that, you can see future probabilities for future rate changes by the Fed. And the next Fed meeting is actually in 2 weeks from today, which, by the way, today is July 12th at the time of filming this video. Can't talk. Anyways, for the next meeting, which is on July 26th, there's a very high probability of around 95% that the Fed is going to increase rates by 0.25 percentage points, or a 25 basis point rate hike to 5.50%. The current rate right now is at 5.25%. So virtually certain, given the stats we have at least today, that the Fed is going to increase rates in their next meeting in 2 weeks by 25 basis points. Then in the next meeting, which is in September 20th to be exact, they're predicting a pause, also a pause in November, and then a pause again in December. In fact, we have to jump until March 20th, 2024 in order to get to an expectation that the Fed is going to decrease rates. So by a 39.5% probability in next March, they're expecting a 25 basis point rate decrease. I would say that is so far off that a lot of data is going to be introduced before then. And of course, a lot could change, of course, as well. So one thing I do want to mention is that even though the street is expecting that the Fed is only going to increase rates by one time this year, or one additional time this year by 25 basis points in their next meeting, that is not what Jerome Powell stated, though, because 3 weeks ago, he stated the following: a strong majority of committee participants, these are participants in the Federal Open Market Committee, which of course dictates the direction of the federal funds rate. A strong majority of committee participants expect that it will be appropriate to raise interest rates 2 more times by the end of the year. Inflation pressures continue to run high, and the process of getting inflation back down to their target range of 2% has a long way to go. So I'd love to hear from you guys. What do you guys think? Do you guys think the Fed's going to increase rates 2 more times this year, or are they going to pause after increasing rates in their next meeting? Let me know in the comments below. So here's what happened regarding the 10-year Treasury note. Let me just refresh this. I'm filming this video at around 2 p.m. Eastern Standard Time on the 12th of July. A big decrease in the 10-year, about 12 basis points down from yesterday's level. I mentioned this because the 10-year is tied very closely to average mortgage rates. So according to Investopedia.com, as of today, average 30-year fixed rates is at 7.44%. That's a fairly significant decrease from yesterday. I believe yesterday when I made a video, I believe their average rates were at 7.59%. Also, according to the Mortgage News Daily, let me just refresh this again, at 6.96%. Again, average rates for people with great credit. That's a huge decrease of 13 basis points from yesterday. Also, Jumbo is at 6.92%, and VA and FHA is around 6.62%. Also, compared to 1 year ago, average rates were at 5.71%. That's an increase of 1.25 percentage points over the last 12 months. Also, by the way, at 6.96% for average 30-year fixed, this is actually the first time we've been below 7% on a daily basis, according to the Mortgage News Daily, since June 28th this year. But still, having said that, rates have been at or above 6.5% ever since May 5th this year. So very high, especially compared to the 3% rates we saw in 2020 and 2021. Now, here's a new report I also want to share with you guys as well. Just announced today from the Mortgage Bankers Association, or the MBA. So despite the fact that we've had rates of above 6.5% for a couple of months now, applications for home loans actually increased last week. I mean, go figure. Applications overall, which of course includes refis plus purchases, increased by 0.9% from last week. And this is actually for the week ended July 7th. And this week's results obviously include an adjustment due to the observance of Independence Day. A lot of people, of course, do not submit applications for home loans during the July 4th holiday. So that's why they include an adjustment here. So overall applications increased by nearly 1% from the previous week, but applications for refis decreased by 1% and also fell by 39% from the same week 1 year ago. Now here's what I really follow, because this is an indication of home buying demand. The seasonally adjusted purchase index increased by 2% from the previous week, but still down by 26% from the same week 1 year ago. According to Joel Kahn, who's the MBA's vice president and deputy chief economist, he stated the following: incoming economic data continue to send mixed signals about the economy, with the overall impact leaving treasury yields higher last week, as markets expect that the Fed is going to continue increasing rates this year. And of course, last week, the average 30-year fix increased to 7.07%, according to the MBA. That was the highest level since November of 2022. You can see this as well when looking at daily rates as well, because on July 6th, the average rate for a 30-year fix was at 7.22%. That was actually the highest rates since November 9th of last year, when rates were also at 7.22%. Also, according to Joel Kahn, he says the jumbo rate, these are rates for high balance loans, the jumbo rate also increased to 7.04% last week, which is a record high for their series here, which dates all the way back until 2011. Now, just taking a step back here, this increase in jumbo rates, again for high balance loans, the highest rates since 2011, according to the MBA, is really going to impact areas that are more expensive. This would be areas like the San Francisco Bay Area, for example, also in Los Angeles as well, because if, of course, rates were increased for these high balance loans, of course, that should decrease home buying demand for those areas. And of course, stay tuned, because I'll post more videos regarding the California housing market and, of course, national trends as well in the weeks and months ahead, of course, as well. Joel Kahn also added the following: purchase applications, which of course is a measure of the number of people submitting applications to buy houses using loans, of course, right? So purchase applications increased, but remained at a very low level, and of course is still down by 26% from the same time 1 year ago. The rise in purchase activity this last week was driven by increases in both FHA and VA purchase applications. This is something a little bit concerning because FHA and VA loans are loans that have a low down payment. VA loans has a 0% loan down payment. And of course, FHA requires only a 3.5% down payment. The reason why I say that this is a little bit concerning is that if these folks actually buy houses using a very low down payment, if and only if home prices were to decrease greatly, of course, these would be the folks at greatest risk of being underwater on their loans. Of course, I'm not saying that's going to happen, but if it does, it makes sense, of course, right? If you have a low down payment, you're going to be at the greatest risk of being underwater on your loans. And of course, leave me a comment below with your thoughts regarding this as well. Regarding their refi index, that actually decreased to the lowest level since early June this year, as demand, of course, for refis and cash out refis remains extremely low, given the fact that rates are over 7% right now. What really strikes me as being unusual is that even though refi demand is still very, very low, out of all the applications for home loans last week, 26.8% came from people doing refis. Okay, let's change gears slightly here and talk about the number of real estate showings in North America, according to showingtime.com. Because for the week ended July 11th, there was an increase of 16.7% in more real estate showings compared to the first week this year. Last year, this time, it was only a gain of 1.2%, whereas in 2021, this time, it was a giant increase of 23.2% compared to the first week of 2021. So when I actually exclude 2021, you can see here that we've had more real estate showings this year compared to the same time frame last year, ever since mid-April this year. As you guys all know, though, I share multiple sources on this channel here. So I'm looking at the Central Lock home showings report on the National Association of Realtors website here. For the month of May, home showings decreased by 3% year over year. So the number of real estate showings, according to the National Association of Realtors, this May was down by 3% compared to last May. Home showings decreased in the Northeast. They fell by 15% there. The Midwest fell by 10%. The West decreased by 4%, but actually increased in the South by 2% year over year. Also, I want to share this right here. This is the number of people searching for homes for sale on Google, because right now, the index right now is at 94, more or less flat from 1 year ago when the index was also 93. So this means more or less that there's approximately the same number of people searching for homes for sale on Google compared to 12 months ago. Also regarding the number of new listings, according to Redfin, for the 4 weeks ended July 2nd, there was 90,000 new listings. That's a decrease of 24.7%. 1 year ago, and also compared to 2021 as well, there's around 120,000 new listings. Now there's only 90,000. So therefore, we're missing approximately 30,000 new listings over the previous 4 weeks nationwide. This is a big, big problem. One reason why we're seeing historically low amount of existing houses for sale. And that, of course, is because new listings have been falling. In fact, new listings have been decreasing compared to the same time frame 1 year ago by more than 20% ever since the 4 weeks ended March 5th this year. Like I mentioned in previous videos, we're seeing a decrease in the number of people who want to sell their houses, but of course we're seeing a huge decrease of contracts being signed between buyers and sellers as well, because pending home sales decreased over the previous 4 weeks, down by 14.2%. Additionally, for the entire year, pending home sales compared to the previous 1 year have been decreasing by double digits. Having said that, to start the year, we were down by 29.2%, which of course is not as bad as the 14.2% decrease we're currently seeing right now. But please leave me a comment below with your biggest takeaways from today's video. Of course, consider subscribing if you've done so already. I appreciate you guys for supporting my YouTube channel and also watching today's video as well. Hope you guys have an awesome day and look forward to seeing you on the next video.